This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Ucke Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market shares continue to fall today as Sino-US tensions escalate. On the continent, most key markets were closed for the Eid holiday. In South Africa, the all-share index was down as, of course, the local market there digests the further easing of lockdown restrictions on June 1st. Now, shares in South African food producer Tiger Brands fell almost 3% on the day, extending a decline for the year to 25%. The firm also announced it could make significant job cuts and asset sales this year. Its first half net income slumped about 75%, and the company scrapped a plan to declare an interim dividend. Now, also coming up on today's show, Kenyan banks face a sluggish year as non-performing loan portfolios expand. COVID-19 pandemic deals a heavy blow to advertising industry in Egypt. And the first Iranian oil tanker arrives in Venezuela amid tension with the U.S. over shipments. Well, let's start the hour here in Kenya, where the central bank says the country's 7 largest banks restructured over $1.6 billion worth of customer loans in April. Now, the restructure relates to the extensions on loan repayments. It is part of the financial sector's response to cushion clients against COVID-19. Households had over $91 million of loans restructured. That's as small businesses suffered lost income and thousands of employees were sacked or had their salaries reduced. Now, further, $762 million relate to restructures on key sectors, including tourism, real estate, trade, building, and construction. The Central Bank of Kenya expects loan restructure requests to spike in the coming months as the economy takes a full blow from the pandemic. Well, let's get a clearer picture of the banking sector's performance so far this year and, of course, the level of disruption in the sector as a result of COVID-19. Ronak Gadia, Director of Sub-Saharan Africa Banks at EFG Hermes, now joins us in London via Skype. Great to have you on the show with us, sir. Now, the expectation is that earnings will take a major hit this first half. Particularly, we'll see an increase in non-performing loans, losses in interest income, and, of course, larger provisions for bad debt going forward. Now, as banks begin releasing those Q1 numbers, what have you seen so far, and what do you expect to see?
Good evening, and thanks for having me. The banks that have reported their first quarter earnings so far, we've seen profitability either increase moderately on a year-on-year basis or remain flat. So as yet, we have seen very little impact from the pandemic. What we have seen is revenue growth has continued to remain strong. The momentum from last year has continued to remain. But at the same time, that has been partially offset by increasing costs and slightly increase in loan loss provisions. But again, I don't think that is related to the pandemic. I think these were provisions that the banks are making on the legacy NPLs. Regarding what I expect to see through the rest of the year, as you mentioned, given the disruption in the economy and macroeconomic activity, we should see some asset quality deterioration. So therefore, loan loss provisions should increase. Likewise, transaction volume should be lower, loan growth should be lower, so revenue growth should potentially decelerate as well. So from here onwards, I think what we will see is banks' profitability in terms of ROE and ROA will potentially moderate through the rest of the year.
Well, as we mentioned earlier, data from Kenya's Bankers Association did reveal that already 95% of lenders in the country have received requests for loan restructuring. Now, how do you expect to see banks managing those risks going forward? Do you think they're well capitalized and certainly liquid enough to weather this pandemic through to the end of the year?
I mean, that's an interesting question. Firstly, how banks will manage this. I mean, this is quite an unprecedented territory that the banks find themselves in, with a wide part of the economy being disrupted. What we have seen, as you mentioned earlier, is banks restructure a large part of their portfolio. I think the hope is that with the restructuring and possibly hoping that the pandemic doesn't last and the economy starts to function again, possibly from the end of this quarter or at least from the beginning of third quarter. That should allow the banks to alleviate major asset quality pressures and therefore not having to recognize significant loan loss provisions. So in that scenario, if that is the scenario that plays out, then yes, I do think banks are sufficiently capitalized to sustain that pressure. But the big uncertainty here is how long the pandemic lasts. If, as everybody's expecting, the economy doesn't restart, in the third quarter, and it prolongs to the fourth quarter, possibly into 2021, then that could become quite problematic, especially for some of the tier two banks who historically have had thinner capital buffers and whose liquidity buffers have also been lower compared to the tier one banks. Having said that, like I said, this is an unprecedented territory, and I would expect the central bank will remain quite supportive of the sector. We have seen, since the pandemic broke out, the central bank has improved or increased the level of liquidity within the system. And so far, despite the level of restructuring, the interbank rate has remained relatively steady, and that shows, the liquidity so far hasn't been that much of a problem, but it could be if it lasts for too long.
Well, let's talk a little bit about the smaller players in the sector, because there is some concern that they were already struggling post those interest rate caps. Now, given the current environment with COVID-19 and the disruption in many sectors, what are the prospects of a wave of consolidation amongst smaller players in the sector?
I think it's a possibility. I think that's something that we have seen quite frequently over the last 3 years. If you look at what has happened, we've seen a number of international banks come into Kenya and pick up some of the smaller tier two banks. So we saw State Bank of Mauritius with Chase and Fidelity, Access Bank acquiring one of the smaller banks, CIB from Egypt. So clearly it does show that there are in this environment, if there are some tier two banks that are struggling, then you should see more M&A activity within that space. But at the same time, like I said, this is an unprecedented territory. The banks globally are struggling, and within Kenya as well. The tier one banks, although they are in a relatively good position, will want to remain quite conservative. So it will depend ultimately on how this pandemic plays out. But yeah, sure, I think there's good prospects for M&A in the current environment.
Well, looking forward, how do you see private sector credit growth being impacted by this situation? It had began rising steadily since, of course, the repeal of those interest rate caps back in November 2019. It has begun to pull back. What is your outlook for this and certainly the overall sector this year?
I think we will see a deceleration. Naturally, banks in this environment will become conservative. Clearly, there's a lot of risk out there, and in times like this, banks do become conservative and moderate their risk underwriting. At the same time, from a demand side as well, there's been quite a big shock economically, and at the same time, I would expect corporates, some of the larger corporates also becoming conservative, because as things stand, they just don't know how the environment will play out and how their revenue outlook will play out. So yeah, overall, I do expect credit growth to moderate or maybe even contract through the rest of the year.
Well, many thanks for your insights, Mr. Gadia. That's Ronak Gadia. He is the Director of Sub-Saharan Banks at EFG Hermes in London. He was joining us via Skype. Well, let's shift focus now to South Africa. The country's airports operator needs treasury support in order to finance up to $594 million of new debt by the year 2025. That is according to a statement released by the state-owned company. Now, since late March, when South Africa declared a state of disaster to contain COVID-19, major domestic airports, such as the continent's busiest OR Tambo in Johannesburg, have closed. Here's CGTN's Yolisa Njamela with more.
Aviation is one of the sectors that have been hardest hit by the coronavirus outbreak, and that sector's financial health and stability depends on air passenger volumes. The Airports Company South Africa, or ACSA, is a state-owned entity that manages South Africa's 9 biggest airports. Those include OR Tambo International in Gauteng, Cape Town International in the Western Cape, and King Shaka International Airport in KwaZulu-Natal. The national lockdown, which began on the 26th of March, has had a number of major effects on ACSA. All domestic and international flights have been cancelled. The only activity has been the repatriation of foreign nationals from South Africa and the repatriation of South Africans abroad.
ACSA is not different from the rest of other companies that were hit by this coronavirus. And I guess with the airline industry being at halt at the moment, it is very much in the same line with everybody else in the industry. So I guess they are proactive and they are predicting that there wouldn't be any frequent...
Critics often point out that the bailouts are a strain to the public finances. The entity says it needs up to 11 billion rand in government guarantees over the next 5 years in order to obtain bank loans to continue operating.
With regard to the airlines that are operating in South Africa, we know they are battling, the biggest being South African Airways, and then the second one that is also under business rescue is Comair. And you would realize that the possibility that those airlines coming to start flying may not happen immediately, may take a little bit of time. So that will take a bit of a knock on their operations because these are their permanent clients that ACSA have. And surely it is proactive steps that they are trying to do to protect the business and make sure that ACSA is a viable business going forward.
Although ACSA expects that it would be able to repay loans once flight operations start to expand again, it foresees that banks will not be willing to lend it money at the moment unless the loans are backed by some form of government guarantee.
If they were to look at acquiring funds, they probably better off going to the BRICS Bank because, as you know, South African economy has been, the rating agencies have been downgraded South Africa. So chances of going to the lenders and ask for money, chances are very much slim.
The company is still evaluating its options to ensure cash preservation. There will be no recruitment for the next 3 months. No incentive bonuses will be provided for, and only essential expenditure for the year will be allowed. Yolisa Njamela for CGTN in Johannesburg, South Africa.
And now let's take a look at our corporate headlines today. Kenya's Nation Media Group has issued a profit warning in the wake of the COVID-19 pandemic. The company says the various response measures rolled out to contain the novel virus have precipitated a significant decline in revenue. Now, the full year ending December 2019, Nation Media Group reported $8 million in profit after tax. That is down from the $10 million reported in the previous year. And South Africa's Tiger Brands could make significant job cuts and asset sales this year. The move comes as Africa's biggest publicly traded packaged food company looks to reduce costs due to COVID-19. Tiger Brands was already battling weaker consumer spending in its main market of South Africa before the pandemic hit. The company now says it has no plans to cut capital expenditure this year, and it is looking to spend about $85 million on growth projects. And Alibaba's stock has dipped by 4% at the Hong Kong exchange after projecting revenue growth will slow this year. The e-commerce giant expects sales growth of at least 27.5% to more than $91 billion. Now, Alibaba has lost more than $70 billion of its market value since COVID-19 began. The company is grappling with not just an uncertain global economic environment, but also any potential fallout from the China-US tensions. And finally, Jaguar Land Rover is seeking a government aid package to weather a collapse in car sales. The UK's largest auto manufacturer is in talks to borrow more than $1.9 billion. Like other car makers, JLR has been burning through cash after COVID-19 restrictions forced the closure of dealerships and its factories. And that is a look at our corporate headlines. Well, let's take a short break now, still coming up on the show. The COVID-19 pandemic deals a heavy blow to the advertising industry in Egypt. And Alibaba's trading platform gives a major boost to Rwanda's coffee exporters.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business. Only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible and why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra Naidoo.
Hello, Naro.
This is how all stories begin. See how they end. Only on Global Business.
Welcome back. Well, let's head to Egypt now. The country's advertising industry is estimated to earn about $500 million of annual revenues, but it has been hit hard by the coronavirus pandemic. The industry had been experiencing a boom over the years, with the lion's share allocated to out-of-home ads. But like the rest of the nation, the business has been deeply affected by the outbreak, with billboards' occupancy rates falling by more than 50% in the past 2 months. Here's Adel El Mahoui with more.
In recent years, outdoors marketing has been a booming industry, with revenues in 2019 exceeding $300 million. This year, however, the COVID-19 pandemic has taken away the vibrant colors these billboards gave to Cairo's landscape. The streets of the Egyptian capital spells it out to any observer that there is a crisis in outdoors advertising. It's the biggest market in the Middle East, but after years of solid growth, it's been seeing the worst hit in recent months.
The year didn't start well, and the COVID-19 crisis added momentum to this decline. Actually, April, the vacancy reached 52%, bearing in mind that 47% occupancy isn't 100% campaigns. So actually the occupancy can be reflected into 27% in general in April. And in May it declined to 45%, which represents like 25% of real money.
And for an industry with high running costs and little revenues, many companies are near bankruptcy.
In our case, I think we might be able to survive for another 2 months. Other businesses actually didn't survive now. and it might be their last month to be able to pay their employees any salaries. In Ramadan, TV was really hit hard.
With a 30% decline in TV revenues and more than 50% for out-of-home, Egypt's $500 million advertising industry is collapsing, dragging with it many supporting service providers.
The most affected stakeholders are the day-to-day employees. And these are the guys that usually they install the messages on the billboards. These are the most affected stakeholder in the out-of-home business, because if you don't have a message to install, then they don't get paid. And the other stakeholders are the print houses, the agencies, the suppliers or the billboard owners.
The Federation of Egyptian Industries is in negotiations with the government to waive licensing fees, which is almost 50% of the billboard's running cost. This step could make stakeholders breathe a bit under the pandemic and sustain through the crisis a little longer. Adil Mahroui, CGTN, Cairo.
Meanwhile, in Kenya, President Uhuru Kenyatta has outlined an 8-point economic stimulus program worth about $500 million in order to help keep the country afloat as the coronavirus pandemic ravages its economy. Now, the government has earmarked about $46 million to hire local labor and $60 million for the education sector. In support of small businesses, the government will also release $100 million to pay held-up VAT returns to boost their working capital. Now, some of $10 million has also been set aside in support of horticulture and flower exporters. Players in the ailing tourism sector will also receive about $20 million in the form of soft loans to help them get back to business. Now, SMEs will now get a loan guarantee from the government, which has set up a $30 million kitty. Well, let's take apart that stimulus plan further. We're joined by Eugene Ngumi. He's a senior consultant at Africa Practice in Nairobi. He joins us now via Skype. Great to have you on the show with us, Mr. Ngumi. Now, at first glance, what are your thoughts on that stimulus package and how those funds have been allocated? Is it enough to revive Kenya's economy post-COVID-19?
Well, at first glance, my thoughts are that the stimulus package is too small. If you look at the projections that are coming out of the central bank and the IMF and the World Bank, GDP growth in Kenya is expected to fall to 1.5% from an expected, what had been predicted earlier to be about 5.9 or 6%. So that, if you do a rough estimate, that's about $3 billion in lost output, or 300 billion shillings, the cost of the first phase of the standard gauge railway. So in comparison to that, 53.7 billion shillings, or as you said, about is not nearly enough to cover the gap. So we're looking at, a stimulus package that's about 0.5% of GDP, whereas we're going to lose more than 4% of GDP. So it probably won't be big enough to help the economy. And in terms of the allocation of funding, the sectors that have been targeted are broadly right. The key to maximizing the impact of the stimulus package will be to get the money out and into the economy as quickly and effectively as possible.
Now, as you rightly said, it's not enough, but sectors such as tourism have been significantly impacted by this pandemic. Of course, it is one of the biggest beneficiaries of this package. But what are your thoughts on how they allocated those funds in the sector towards soft loans, towards renovation of infrastructure? Is it sufficient to restore Kenya's tourism sector once, the funds come through?
Restore, maybe not, but it is significant, and it will be very helpful to the sector. The soft loans will keep many of the facilities and operators alive during this period. And then the renovations are critical, because in order to attract tourists back to Kenya when international travel is finally allowed, we're going to have top-notch facilities and top-notch tourist attractions, and renovating while tourists are away is actually a very, very good idea of doing that. Of course, they'll have to be coupled with some sort of branding and marketing plan that'll help, advertise those renovations and the improvements that have been made with the money the government is giving, so that we can effectively restart the sector when travel starts again, both domestically, regionally, and internationally.
Now, of course, there are a number of ways we'll see these funds being channeled into various sectors: employment programs, farm input subsidies, as well, infrastructure revival, as we just mentioned. But some are arguing that we should have seen more of these funds channeled towards credit guarantees, especially for small and medium enterprises in the country. Do you agree with this? And what sectors do you think should have been the biggest winners in this package?
I absolutely agree with that sentiment, and it's currently in the works. So if you dig deeper into the documents that Treasury used to outline this stimulus to the National Assembly and Parliament, they very clearly state that the money they've put in place for the credit guarantee scheme is seed funding. And the central bank governor has mentioned publicly on a couple of occasions that he's working with the development funding institutions and multilateral lenders to build up a credit guarantee fund. So we expect that to be much, much bigger. I think the critical thing in terms of how it's targeted and how it gets to market is that it's not just targeted at SMEs, but MSMEs as well, the micro enterprises. About 50% of Kenya's MSMEs are micro enterprises. So in order to cover that market, and these are businesses, if you look at that whole sector, that employ 90% of Kenya's non-farming labor population, it'll be critical that they get the funds they need to restart business when the government starts lifting restrictions. And finally, in terms of industry or sector targeting, I don't think that's the right way to go. It'll be too differentiated and too diffuse with some sort of credit guarantee scheme. What'll be important is that the guarantee scheme is funneled through all the relevant channels. So not just through banks, but also through the digital lending applications, through SACCOs, which are credit cooperatives here in Kenya, as well as microfinance institutions, to ensure that all MSMEs can take advantage of the credit guarantee scheme, because they serve as the engine of the Kenyan economy alongside agriculture, and if they can get restarted, the economy can get restarted.
Now let's talk about how the government plans to fund this plan. Now, before COVID-19, we know the country was already facing some challenges funding projects, infrastructural projects, and of course boosting its revenue as well. What are your views on how Kenya plans to fund this plan, given, of course, the limited fiscal space we know it has? It says it plans to do this through transfers from other items in the budget, financial aid, as well as surpluses from state-owned corporations. What are your thoughts on that?
Well, that signals to me that the government is still trying to preserve some form of fiscal responsibility and trying to keep from taking on too much debt around a stimulus plan, hence cutting some parts of the budget and using aid and state corporation profits to fund this program. In terms of the broader fiscal situation, I don't think it'll help much. In combination with the stimulus package, a few weeks ago, the government passed a package of tax cuts, which is going to further reduce tax revenues anyway. And then we've also had the increase in spending that we've had as part of the crisis response. So I won't be surprised personally if you see Kenya's debt load go over the 70% debt to GDP mark in the next 12 to 18 months. And in terms of the budget looking forward, as I said, I don't think the stimulus package is big enough. And if the government plans any additions, it'll require a much larger reworking of the budget. And preserving fiscal space in that sort of situation will require some form of or a combination of negotiations with lenders around issues like debt pauses and restructuring our debt book to make it more long-term and more sustainable.
Quite right. Well, we'll certainly be watching. Thank you so much, Mr. Ngumi, for your insights. That was Eugene Ngumi. He's a senior consultant at Africa Practice here in Nairobi. Well, moving on now, Chinese e-commerce giant Alibaba Group, through the electronic world trade platform, is now hoping to become a digital game changer in Africa. Through virtual platforms, it is setting the drive towards globalization by reducing barriers to trade for small and medium enterprises. Now, recently, it helped promote Rwanda's coffee brands with over 1.5 tons sold online to China. Here's CGTN's Daniel Arap Moy with more.
Alibaba Group, through the electronic world trade platform, is helping to connect African companies with consumers in China. A recent online event featured Rwanda's Gorilla Coffee, a brand from Rwanda Coffee Company. During its live streaming session, the brand sold its stock of 3,000 bags of coffee in just minutes. Senior manager of Alibaba Globalization Office in charge of African affairs hopes to bring more African produce to other markets via the EWTP, stressing the importance of revitalizing global trade.
We definitely believe in the future of globalization. In fact, I'm very optimistic about the future of globalization. So actually, digital platform, digital economy, or with digital infrastructure become even more important to drive globalization during this particular era when the world is impacted by the COVID-19 pandemic.
Rwanda's Gorilla Coffee, which is available on Alibaba's platforms, has seen over 20 million Chinese coffee lovers access the product through Tmall, a subsidiary online platform of Alibaba.
First proposed by Alibaba Group founder Jack Ma in 2016, the electronic world trade platform has been recognized by the G20 and has launched in China, Rwanda, Ethiopia, Malaysia, and Belgium.
The EWTP, an Alibaba-led initiative, aims to reduce barriers to global trade for small and medium-sized enterprises in Africa and globally through e-commerce.
We're trying to empower the Rwanda coffee producers to produce more coffee that is more tailored for Chinese people, Chinese consumers' taste. So in that case, we do see great future for its market promise in China.
Rwandan coffee has become increasingly popular in China, with branded coffee chains like Starbucks stocking it. Rwandan producers are now able to sell directly to a much larger set of customers than before, while bypassing costly intermediaries.
We were able to sell coffee. In 1 second, we sold 3,000 tons of coffee on the Jack Ma electronic world trade platform. We hope we can do more of that. Africa itself is doing the African Continental Free Trade Area Agreement conversations, where we hope to open our own continental markets to trade more, to trade better, and to produce more goods that eventually we can also sell to China.
Rwandan farmers who used to earn only $1 for a kilogram of coffee beans have since seen their incomes increase substantially since the introduction of the EWTP. For now, Alibaba has signed agreement with Rwanda and Ethiopia to develop EWTP in Africa. Daniel Arap Moi, CGTN, Nairobi, Kenya.
You are watching Global Business Africa. We're going to take a short break now, but still to come on the show. The first Iranian oil tanker arrives in Venezuela amid U.S. tension. And domestic flights resume in India as coronavirus restrictions ease up.
How will your world change today? What happens here? What happens there? Or what do you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Just about 1:30. Here's a recap of today's top headlines. Burundi's ruling party candidate and retired General Evariste Ndayishimiye has won the presidential election. The Electoral Commission says Ndayishimiye got 68.72% of the vote, ahead of the opposition candidate Agathon Rwasa, who received 24.19% of the vote. Now, around 87% of the 5.11 million registered voters took part in the polls. Ndayishimiye will now replace President Pierre Nkurunziza, who has ruled for 15 years. And And the continent is celebrating Africa Day. The day was officially marked on 25th of May in 1963 when the Organization of African Unity, now known as the African Union, was formed. The day was to commemorate the fight against colonialism. This year, though, due to the coronavirus pandemic, the celebrations have been moved online under the theme Silencing the Guns. They include a special virtual broadcast featuring speeches by AU leaders Cyril Ramaphosa, Musa Faki Mahamat, with a special guest appearance by former Zambian President Kenneth Kaunda. And Tanzanians are celebrating what they believe is a victory in combating the spread of COVID-19 in the country. President John Magufuli says the number of coronavirus patients have declined. In Dar es Salaam, Regional Commissioner Paul Makonda asked residents there to celebrate that development in whatever way they could. Of course, Tanzania has confirmed 509 cases of COVID-19 and 21 deaths so far. And that's a recap of today's top headlines. Now, the first of 5 Iranian oil tankers sailing across the Atlantic have entered Venezuela's waters. It is carrying more than 1 million barrels of fuel to help alleviate shortages in the former oil exporting nation. Now, the U.S., which has imposed sanctions on both Venezuela and Iran, says it is monitoring the convoy. Both Caracas and Tehran, however, have warned Washington not to interfere with the delivery. CGTN's Stephen Gibbs explores.
A military escort for an Iranian tanker. These images from the state-backed channel Telesur show the Fortune, the first of 5 ships to arrive in Venezuelan waters. On board, it's believed 300,000 barrels of gasoline. The ship was greeted by the captain of the frigate on behalf, he said, of the Venezuelan people. The governments of Venezuela and Iran are portraying this as a victory. 2 countries, both sanctioned by the United States, helping each other in times of need. But why does Venezuela, which has vast oil reserves and has long given away gasoline effectively for free, now depend on others for its fuel? Under maintenance and a series of major accidents means that Venezuela produces only a fraction of the gasoline it needs. It relies on imports, but they have been hit by US sanctions against what Washington says is the illegitimate Maduro government. Last month, Russia's Rosneft, which helped Venezuela buy gasoline, pulled out of the country under the pressure of those sanctions. Venezuela turned to Iran, which immediately offered assistance, including sending technicians to try to restart those domestic refineries, despite warnings from Washington that such help was unwelcome.
Not let that happen.
Impresionante, Irán. Nuestra hermana Irán, salam aleikum. The support has been enthusiastically received by President Maduro. He has also been highlighting Venezuela's missile defense system in an apparent warning to the US.
Probando la puntería, la precisión.
In Caracas, where people often have to queue for over 24 hours to fill up, there were some doubts as to whether the Iranian deliveries would be a long-term solution. This man said it would be better if there was national production. Another customer was concerned about what the price of the imported gasoline might be. But those worries aside, this does seem to be another example of how the Maduro government has a knack of turning a crisis into an opportunity. Stephen Gibbs, CGTN.
Well, let's shift focus now to China's political season. Lawmakers and advisors have come to the 2 sessions with proposals to boost telecoms, especially in 5G, as well as big data and AI. Now, reporter Zheng Yibing caught up with the head of a leading Chinese think tank in information technology.
As a new engine of China's social and economic growth, information and telecommunication technologies are playing more important roles than ever. There are growing calls for their fast and sound development, a trend seen at this year's two sessions.
What we'll focus on is how to use new information technology to enable other industries to have better development, especially in the real economy, the public health sector, and all others related to people's livelihoods.
Last year, China initiated its 5G commercialization. Almost 200,000 base stations have been built nationwide, and another 500,000 are expected to be built by the end of the year. Closely related with 5G, more big data centers are being built as part of infrastructure construction, which aims to boost investment and economic growth.
We believe that it will directly boost investment because it is, in fact, the capital-intensive industry.
China has initiated a couple of projects on new generation artificial intelligence technologies with total investments of around 1 billion yuan, and the country is further integrating AI with various industries.
It has very wide application in security, financing, and even the epidemic this time. Our AI Development Union collected some 500 related application cases during the epidemic, including technologies related to thermal imaging.
Liu predicts the scale of AI in China this year could reach 90 billion yuan and the growth rate could reach 30%. So this year, with the new development investment in the sector, more proposals have been submitted. The NPC deputy said she and others will further push forward a healthy development in the sector and apply new information and communication technologies in more fields and better serve people's needs and improve people's livelihoods. Zheng Yibing, CGTN, Beijing.
Now, new infrastructure has been a buzzword at this year's two sessions, with the concept even written into the annual government work report for the first time. So what exactly is this so-called new infrastructure? Well, CGTN's Michael Wang explores.
So, what's China's new infrastructure all about? Compared to traditional infrastructure such as roads, railways, and bridges, the new represents infrastructure built on advanced technology and digitization. It's infrastructure that's data-driven. At its core, this includes 5G networks, artificial intelligence, the industrial internet, the Internet of Things, data centers, and using technology to make existing infrastructure more intelligent and connected. Traditional infrastructure comes mostly from government spending, but new infrastructure seeks to draw in more investment from businesses as well as private investors. New infrastructure, though, is not a new concept. China has consistently invested in innovation. However, the new infrastructure idea gained pace and widespread media attention during a high-level policy meeting on March 4th, where policymakers called for quickening the pace of new infrastructure investment to aid in China's economic recovery from the coronavirus epidemic. In the short term, new infrastructure acts as a counter-cyclical buffer to help stabilize the economy from COVID-19 disruptions. But in the medium to long term, new infrastructure lays the foundation for China to remain competitive and to succeed in the age of Industry 4.0. It drives efficiency by better matching supply with demand, enables smart cities for sustainable living, boosts productivity by upgrading manufacturing, speeds up digitization of the economy, and solidifies data's position as a new factor of production.
Well, let's head to India now. The country has partially resumed domestic flights after a 2-month lockdown. This as the country recorded its highest daily total of 7,000 coronavirus cases on Monday. Now, passengers are being asked to maintain social distancing in queues and wear masks as they undergo thermal screening. The airlines are now forced to keep middle seats open. India did start to ease lockdown measures earlier this month by reopening its shops and resuming manufacturing. Now, when the world went into a coronavirus lockdown, many factories were shut down as supplies dwindled and workers stayed at home. Now, the problems have been compounded by the fact that many manufacturers rely on parts supplied by smaller producers from all around the world. That's a system known as the global supply chain. But as many nations are now trying to restart, the global supply chain is a huge problem as some borders still remain closed. And of course, transport links have slowed down. Here's Tony Chang reporting from Thailand.
Workers at an aluminium pressing plant in central Thailand hoist massive rolls of sheet metal into place, ready for the presses to stamp them into shape. Their biggest client is the auto trade, big brands like Toyota and Honda that have factories here. But since the coronavirus crisis started, the orders have dropped off sharply. Factories have shut down and the supply chain has broken.
The sales is decreased about 70 or 80%. It is impact a lot. Like in auto industry, like there are many parts that need to be supplied from many places around the world. Like if you miss only one small part, the car cannot be assembled.
Now the company is trying to manufacture buses and boats for sale in the domestic market. But in these troubled economic times, buyers are hard to find. At the container port in Bangkok, little is moving in or out. Thailand, like many countries in Southeast Asia, has flourished as a major part of the global supply chain. Although the health crisis appears to have been averted here, the economic impact may be devastating. Honda, who have a huge factory in Thailand, have posted their lowest earnings in 4 years. Although manufacturing is starting to resume, problems in the supply chain have slowed production to a trickle. And with huge question marks over global consumer spending, expectations for the future are bleak. Faced with these difficult circumstances, many multinationals could well make the decision to move back to their base of operations.
The company will ask whether do I reinvest in the original location or do I go back home where maybe the administration will give me some tax breaks or some subsidies, and that will reduce my cost.
So is this likely to mean the end of globalization?
No. I think we will see a rebirth of globalization in a different form.
That may be true, but to rebuild the trade links lost in the past months could take years, and many companies will not survive. Modern Thailand, like many countries here in Southeast Asia, built itself on exports and trade as commodities were shipped down the Chao River into the Gulf of Thailand and all across the world. But the coronavirus has broken those links, and at this stage it's very hard to see when they'll be joined back together again. Tony Chang, CGTN, Bangkok.
Now, Asian countries have been hugely successful in turning their economies around and uplifting their nations. A new book entitled Asian Aspiration outlines a case-by-case study of about 10 nations, detailing their actions, their success and their failures. It also explores how Africa can apply these lessons to its own developmental path, especially now that economies have been halted to deal with COVID-19. CGTN's Julie Shire reports.
Africa is home to half the world's poorest. It's likely to worsen with economic activity dwindling as the continent battles COVID-19. Authors of the Asian Aspiration say Africa can draw on lessons from Eastern countries. Asia managed to lift 1 billion people above the breadline in just over 40 years.
I think the most important one, especially for this time, is using a crisis as an opportunity for reform. Throughout Asia, throughout its history, its leaders have taken the opportunity of a crisis situation, for example, a war or a famine or a massive event, as an opportunity to make the necessary reforms at a time when it's possible, when otherwise it would have been politically infeasible.
It will, however, be a tall order. The fallout from the pandemic will cost millions of jobs and decimate GDP.
Well, most of these Asian examples didn't actually have a lot of money when they started off this process. They didn't invest themselves. They got others to invest in them. The difference between successes and failures in Africa post-COVID is going to depend on the extent to which African countries are going to be able to diversify. And it's not just those that are producing mining goods or agricultural goods. It's also particularly for those that are major oil producers.
Africa's growth story has been largely unequal before the pandemic. A recovery will come down to bold vision, strong leadership, and the will to create inclusive growth.
Being very pragmatic in terms of policies and infrastructure, not just using debt to fund salaries, but to actually fund specific areas of infrastructure, mainly on ports. The importance of creating low-cost industrial bases and using that to leapfrog further up the value chain into services ultimately. And that's a progression that's been shown across Asia. And then this incredible laser-like focus on growth.
It will be a long road back from COVID-19 for many African economies, but drawing on lessons from Asia, the crisis provides an opportunity to map out a fresh growth path through strong vision and leadership. Julie Shire, CGTN, Johannesburg, South Africa.
Well, let's now shift focus, take a look at commodity markets today. Oil prices, which of course have been driven higher for the past 4 weeks, were pretty steady today. The holiday in some major cities globally dampened trading as, of course, rising concerns over demand recovery continues to offset supply cuts. Meanwhile, gold prices were down today. Traders say the play into stocks and other riskier assets has probably supported risk appetite in the market, and that has diminished the appeal for gold in the short term. Well, let's head into a short break. Still to come. COVID-19 crisis opens up new opportunities for Kenyan software developers. Now, COVID-19 has wreaked havoc on thousands of businesses, both large and small, across the globe. However, it's not all doom and gloom for some businesses. Well, on Grassroots tonight, CGTN's Nick Mudimba takes a look at how this global health crisis has become a boon for software developers and engineers.
As the day starts, it's business unusual for Jeremiah Dindi, a software engineer. A lot has changed nowadays as more and more people work from home. The demand for the services of software developers is on the rise, largely from clients seeking innovative solutions during these COVID-19 times.
We are proving to be resilient because of the nature of the situation right now. There's a need for contactless interactions, but people still need the services as usual. So there's an increased demand of the platforms to avail that for people to be able to provide the services, to provide the products remotely or, contactless.
These workplace changes have seen many software developers working from home and handling their tasks remotely.
Some of them who actually embraced working from home and remote best practices earlier on are not finding it to be a totally new thing to work with. And this is the source of this resilience, right? And it's emerging because of how they crafted their workplaces to ensure that engineers, for instance, are able to work flexible hours and they're able to work remotely.
The number of information technology jobs advertised has increased as firms seek to bolster their online operations.
Today in technology, right, in the bucket of technology, a lot of new careers are going to emerge, right? It means if someone can create a website, if you choose to be a website designer, for instance, you can create the graphics of a website, you can take photos as a photographer. So demand is going to actually come up in the area of tech, even though some industries are already hurting and having layoffs, right? So from a website, you can see the people who are writing content writers are going to have a lot of opportunity for them to showcase about different products and services when it comes to writing copy.
As the demand for such services increases, there's also interest from those who want to try their hand in the tech industry, and Jeremiah has some expert advice for them.
they say in software development, well, they say Google is your friend. So I'm sure if you just Google, how to maybe come up with a website or development, you will see a bunch of results over there. But ones I've used personally is a Code Academy platform. And then there is also players like Oracle, who have been graceful enough during this period to give their platforms for a period of time, a limited period of time, for you to be able to learn or to get the skill for free. Otherwise, these resources are normally paid for.
As the fight against COVID-19 continues and the world adjusts to the new normal, there's no doubt that many IT positions will still need to be filled, helping those in the sector secure their careers. For software developers, it's indeed a learning curve period. They're getting projects, yes, but the only difference is that they're working from home and they're doing it even better. Reporting for CGTN, my name is Nick Mudimba in Nairobi, Kenya.
Well, before we go, here's a quick look at Africa's currencies today. Emerging market currencies did weaken today as, of course, the dollar gained some momentum. South Africa's rand held steady, though, against the dollar. And that's after President Cyril Ramaphosa announced a further easing of the coronavirus lockdown from June 1st, allowing the vast majority of the economy to return to production. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Ucke Okoronkwo, and the rest of the team, thanks for watching.